There is a lie that lives at the heart of the stock market. It's a seductive, comforting, and devastatingly expensive lie. It's plastered across the headlines of financial news channels, it's the centerpiece of glossy annual reports, and it's the first thing most CEOs will boast about during an earnings call. The lie is this: that a growing business is always a good business. That rising sales, expanding market share, and bold, splashy acquisitions are the definitive signs of a healthy investment. We are taught to cheer for the CEO who is always in motion, the empire builder who is constantly adding new divisions, entering new markets, and making news. We see the top-line revenue number climb year after year, and we feel a sense of security, a belief that we have placed our capital in the hands of a winner. But this belief, this addiction to the narrative of growth, is a trap. It is a costly market mistake that allows mediocre and even value-destroying executives to hide in plain sight, all while they systematically dismantle the very wealth you have entrusted to them. The truth, a truth that has been the bedrock of the greatest investment fortunes ever built, is far more subtle and infinitely more powerful. It requires you to look past the headlines, to ignore the cheering crowds, and to ask a single piercing question that changes everything. It is the question that separates the truly brilliant corporate leaders from the merely active ones. The question is not, how fast is this CEO growing the company? The question is, how skillfully is this CEO allocating the company's capital? This is the final promise. It is the core principle that, once understood, allows you to analyze a business not as a gambler watching a stock ticker, but as a true business owner, a partner with management. It transforms your entire perspective, turning financial statements from impenetrable walls of numbers into a clear, open window into the mind of the person at the helm. You learn to see not just what they are doing but why they are doing it. You learn to distinguish between the rational, disciplined steward of your capital and the ego-driven empire builder who is expanding their kingdom at your direct expense. Warren Buffett, the man who built a $500 billion empire from the ashes of a failing textile mill, did not achieve this by chasing sales growth. He did it by mastering the art and science of capital allocation. He understood that a CEO has only a handful of choices to make with the profits a business generates, and the wisdom they apply to those choices is the single greatest determinant of long-term shareholder value. They can reinvest in the existing business, they can acquire other companies, they can pay down debt, they can issue dividends, or they can buy back their own stock. That's it. That is the entire menu of options. The operational details of running the day-to-day business, managing supply chains, marketing products, motivating employees, are, of course, important, but they are secondary. The real leverage, the activity that creates or destroys fortunes, lies in those 5 fundamental capital decisions. A CEO can be an operational genius, squeezing every last penny of efficiency out of the business, but if they then take that hard-earned cash and spectacularly overpay for a foolish acquisition, all that operational excellence is rendered meaningless. They have simply become a more efficient conduit for destroying your money. This journey we are about to embark on is a deep dive into this crucial, often overlooked skill. It is a form of advanced stock picking that goes beyond simple price-to-earnings ratios and dividend yields. This is management analysis. It is the financial education that bridges the gap between being a passive retail investor and an engaged, analytical business owner. We will deconstruct this principle into 5 distinct pillars, each one a powerful lens through which to view any company and any CEO. We will explore the foundational anecdotes from the lives of the world's greatest business leaders. We will dissect the underlying psychological principles and cognitive biases that cause most CEOs and investors to fail, and we will provide you with the applied mental models, the practical blueprints that you can use to immediately upgrade your own investment process. By the end, you will no longer be seduced by the lie of empty growth. You will possess the tools to identify management teams that think rationally, act in your best interest, and are quietly, systematically compounding your wealth. You will learn to spot the CEOs who will make you rich, and just as importantly, you will learn to spot and avoid the ones who, despite all their fanfare and impressive headlines, are on a path to destroy your capital. This is the key to true portfolio growth, to beating the market, and to achieving the kind of financial freedom that comes not from luck, but from superior judgment. Our first pillar, the very foundation upon which this entire philosophy rests, is the understanding of the CEO's true role. They are an investor first and a manager second. The highest and best use of a chief executive officer's time and intellect is not in optimizing the factory floor, but in making intelligent decisions about where to deploy the cash that the factory floor generates. This is their primary responsibility to you, the shareholder. Everything else is a means to this end. The common perception is of a CEO as a kind of supermanager, a charismatic leader who inspires the troops and drives operational excellence. And while leadership is a valuable trait, it is dwarfed in importance by capital allocation skill. A mediocre operator who is a brilliant capital allocator will, over the long term, create vastly more wealth than a brilliant operator who is a terrible capital allocator. The math is unforgiving. One good capital decision can create more value than 10 years of incremental operational improvements. Conversely, one disastrous capital decision can wipe out a decade of hard work overnight. To truly understand this concept, we must turn to the man Warren Buffett himself has called the greatest CEO in American history, not Jack Welch, not Steve Jobs. His name was Tom Murphy, the quiet, unassuming leader of a small, struggling UHF television station in Albany, New York, called Capital Cities Broadcasting. The story of Tom Murphy is the quintessential foundational anecdote for this pillar. It is the masterclass in prioritizing capital allocation above all else. When Murphy took the helm in 1966, Capital Cities was a tiny, overlooked player in the media landscape. He was not a flashy television executive. He was not a programming genius. He was a graduate of Harvard Business School who viewed the company not as a collection of TV and radio stations, but as a machine for generating cash. And his singular focus was on what to do with that cash. He and his partner, Dan Burke, ran the business with a culture of extreme frugality. They were relentless about cost control, not because they were cheap, but because every dollar they saved was another dollar they could deploy to buy more assets. Their operational philosophy was radical in its simplicity. Hire the best people, give them the autonomy to run their divisions as if they were their own businesses, and then get out of their way. The headquarters of Capital Cities was famously Spartan, with a staff so small you could fit them in a large van. They didn't have layers of middle management or corporate strategists. Murphy and Burke focused on one thing: finding and acquiring undervalued media properties. They weren't interested in glamour. They were interested in cash flow. They bought newspapers, radio stations, and television stations in small to mid-sized markets, places Wall Street largely ignored. And they never, ever overpaid. Murphy had an ironclad discipline. He knew what a business was worth, and he would not pay a penny more. He was perfectly happy to sit on a growing pile of cash for years, waiting for the right opportunity at the right price. This is the first mark of a master allocator: the ability to do nothing, the patience to wait for the fat pitch. This methodical, patient approach continued for 2 decades. Capital Cities grew from a tiny company into a formidable media powerhouse, all through shrewd, disciplined acquisitions funded by the cash flows of their existing businesses. Their stock performance was staggering, compounding at rates that made a mockery of the S&P 500. Then came the deal that would cement Tom Murphy's legacy. In 1985, the landscape of media was changing. The 3 major networks, ABC, NBC, and CBS, were seen as lumbering, bureaucratic giants ripe for disruption. And one of them, ABC, became a takeover target. It was a Goliath. At the time, ABC was more than 3 times the size of Capital Cities. The idea that this small, frugal company from Albany could acquire a titan of American broadcasting was, to most of Wall Street, laughable. But Tom Murphy saw an opportunity. He saw a collection of excellent assets, powerful television stations, the ESPN cable network, which was just beginning its ascent, that were being run inefficiently by a bloated corporate structure. He made his move. In a deal that shocked the business world, Capital Cities announced it was acquiring ABC for $3.5 billion. It was a minnow swallowing a whale. To fund the deal, Murphy needed a partner, and he turned to the one man in America who would instantly understand the brilliance of the move: Warren Buffett. Buffett's Berkshire Hathaway invested over $500 million to help finance the acquisition, a massive sum for Berkshire at the time. Why? Because Buffett wasn't betting on the ABC brand or the glamour of network television. He was betting on Tom Murphy. He knew that Murphy's proven genius in capital allocation, applied to the enormous cash flows of ABC, would create an explosion of value. And he was right. Murphy and Burke descended upon the lavish, famously wasteful corporate culture of ABC like a cleansing fire. They sold the company's private jets. They eliminated executive dining rooms. They slashed the bureaucracy that was stifling the company's core businesses. They applied the same decentralized, cost-conscious operational philosophy that had worked so well for decades. The result was a dramatic and immediate increase in profitability. The cash that was once being wasted on corporate perks was now flowing to the bottom line, ready to be redeployed. The acquisition of ABC was a triumph not of operational synergy in the way most people think of it, but of applying a superior capital allocation mindset to a larger pool of assets. Tom Murphy demonstrated that the ultimate skill of a CEO isn't running the business you have today, but intelligently using its profits to build the business you will have tomorrow. This story cuts to the heart of a powerful underlying psychological principle that explains why so few CEOs can replicate Murphy's success: the action bias. Human beings are hardwired to believe that action is superior to inaction. In a corporate setting, this is amplified tenfold. A CEO is expected to be dynamic, to be a change agent, to be constantly making things happen. The board of directors, the shareholders, and the financial press all reward activity. A CEO who simply sits on cash, waiting for the right opportunity, is often criticized as being passive, uninspired, or lacking a vision for growth. This relentless pressure to do something creates a dangerous compulsion. It leads CEOs to chase acquisitions they shouldn't, to launch expensive new projects with dubious returns, and to expand into new markets they don't understand, all for the sake of being seen as active and decisive. They are terrified of being the one executive who, when asked what they did last quarter, has to answer, "Nothing. We waited." Yet, as Tom Murphy and Warren Buffett have proven, intelligent inaction is one of the most powerful weapons in a capital allocator's arsenal. Overriding this deep-seated action bias is a hallmark of superior executive decision-making. It requires immense personal discipline and a corporate culture that values rational decision-making over frenetic activity. It is the conscious choice to prioritize being right over being busy. So how can we, as retail investors, translate this into a practical instruction manual? How can we systematically analyze whether a CEO is a Tom Murphy or just another hyperactive empire builder? The answer lies in what we can call the 5 choices framework. This is the blueprint for analyzing a CEO's capital allocation decisions. Every dollar of profit a company generates presents the CEO with these 5 and only these 5 choices. Your job is to evaluate how well they make them. Choice 1. Reinvest in the core business. This is usually the best possible use of capital, provided the business can generate high rates of return on that incremental investment. If a company has a powerful brand, a unique technology, or a dominant market position, pouring money into strengthening that moat through research and development, expanding production capacity, or improving its products and services can create immense value. As an investor, you must ask, what is the return on invested capital, ROIC, for this business? If the ROIC is consistently high, say above 15%, then the CEO should be reinvesting every penny they can back into the business. The red flag is a CEO who continues to pour capital into a low-return business. This is the equivalent of adding more and more fertilizer to a barren field. Choice 2. Acquire other businesses. This is the riskiest, most glamorous, and most frequently abused of the 5 choices. A smart acquisition, bought at a reasonable price, can be transformative. The capital city's acquisition of ABC is the prime example. But the vast majority of mergers and acquisitions fail to create shareholder value. They are often driven by ego, the desire for growth at any cost, and the siren song of synergies that rarely materialize. When you see a CEO announce an acquisition, your analysis should be ruthless. Did they pay a reasonable price? Is the acquired business in an industry the management team understands deeply? Is the strategic rationale clear and logical, or is it filled with vague corporate jargon? Choice 3. Pay down debt. This is the most straightforward and often the most prudent choice, especially for a company with a heavy debt load or in a cyclical industry. Reducing debt strengthens the balance sheet, reduces interest expense, which boosts earnings, and increases financial flexibility for the future. A CEO who prioritizes debt reduction in uncertain times is demonstrating a conservative, owner-oriented mindset. They are focused on survivability and long-term stability, not short-term glory. This is a particularly important factor in rising interest rate environments, making it a key part of any modern management analysis. Choice 4. Pay dividends. A dividend is a direct return of capital to you, the shareholder. For mature companies that generate more cash than they can intelligently reinvest in their core operations, a consistent and growing dividend is a sign of a healthy, shareholder-friendly business. It enforces a certain discipline on management, as that cash cannot be used for wasteful projects or overpriced acquisitions. The key is to ensure the dividend is sustainable and doesn't starve the business of necessary capital for maintenance and sensible growth. Choice 5. Buy back stock. This is perhaps the most misunderstood of all the choices, and the one that most clearly separates the brilliant allocators from the mediocre ones. A share buyback is when a company uses its cash to purchase its own shares on the open market, reducing the total number of shares outstanding. If a company's stock is trading below its intrinsic value, a buyback is a wonderfully accretive act. It's like the company is reinvesting in its own best asset, itself, at a discount. Each remaining shareholder now owns a slightly larger percentage of the business. However, if the stock is trading above its intrinsic value, a buyback is an act of pure value destruction. The CEO is using your cash to overpay for an asset. A CEO's approach to buybacks is a powerful litmus test. A rational CEO buys back shares aggressively when the stock is cheap and stops when it becomes expensive. An irrational CEO buys back shares when the price is high, often to prop up the stock and meet executive compensation targets. By using this 5 choices framework, you can move beyond simply looking at a company's sales growth and begin to grade the CEO's actual performance as a capital allocator. You can look at their history of decisions and build a scorecard that reveals their true skill, a critical component of any value investing strategy designed for portfolio growth. Now let's explore the antithesis, the path of the 99% of CEOs who get this wrong. This is the path of the empire builder, the executive obsessed with size over profitability, with headlines over shareholder value. There is no more catastrophic example of this mindset than the merger of AOL and Time Warner in the year 2000. It stands as a monument to the destructive power of prioritizing growth above all else. At the peak of the dot-com bubble, AOL was the king of the internet, a high-flying company with an astronomical stock price. Time Warner was an old media giant, a collection of powerful but slow-growing assets like Warner Brothers Studios, HBO, and Time Magazine. Steve Case, the CEO of AOL, and Gerald Levin, the CEO of Time Warner, were blinded by a grand vision. They believed that by combining AOL's new media distribution with Time Warner's old media content, they could create an unstoppable, vertically integrated media conglomerate for the 21st century. The deal was hailed as a visionary masterpiece. On paper, the growth story was intoxicating. The combined company would dominate the internet, television, film, and print. It was the ultimate empire. The problem was the price. AOL, using its massively inflated stock as currency, acquired Time Warner in a deal valued at a staggering $164 billion. It was the largest merger in history. The CEOs talked endlessly about synergies, about cross-promotion, about a new media paradigm. What they didn't talk about was the sober reality of the numbers. They were mating a wildly overvalued, fad-driven internet company with a solid but mature media business. The cultures clashed immediately. The promised synergies never materialized. And then, the dot-com bubble burst. AOL's business model, based on dial-up internet subscriptions, rapidly became obsolete with the rise of broadband. Its value plummeted. The financial connection here is brutal and direct. The merger created an entity with an enormous amount of goodwill on its balance sheet, an accounting term that represents the premium paid for an asset over its tangible book value. In this case, the goodwill was a mountain of air, representing the bubble-era valuation of AOL. In 2002, the company was forced to take a goodwill write-down of nearly $100 billion. It was, at the time, the largest annual corporate loss ever reported. Let me repeat that. A single capital allocation decision, driven by ego and a flawed vision of growth, led to the destruction of $100 billion in shareholder value. All the operational excellence at HBO, all the blockbuster movies from Warner Brothers, all the journalistic integrity at Time magazine, none of it mattered. One terrible, top-level decision by the CEOs wiped it all away. The stock of AOL Time Warner collapsed by over 90%. It was a financial cataclysm. This is the ultimate lesson. A CEO's primary job is not to run the business. It is to allocate its capital. The story of Tom Murphy shows the immense wealth that can be created when that job is done with genius. The story of AOL Time Warner shows the utter devastation that occurs when it is done with folly. As an investor, learning to tell the difference is everything. The second great pillar in our framework for judging a CEO's true worth is the principle of the circle of competence, applied not just to an individual investor, but to corporate strategy as a whole. A great capital allocator possesses a deep and humble understanding of what their company knows and, just as importantly, what it does not know. They make investments and acquisitions exclusively within this circle, leveraging their existing expertise to create genuine value. They resist the allure of venturing into exciting but unfamiliar territories. The opposite of this is a phenomenon that the legendary investor Peter Lynch famously termed diversification, the tendency of companies to expand into businesses they don't understand, thereby diluting the profitability and focus of their excellent core operations. A CEO who leads a company down the path of diversification is a clear and present danger to your capital. They are expanding the empire not for strategic advantage, but for the sake of expansion itself, often with disastrous consequences for shareholder value. Perhaps the most powerful foundational anecdote for this pillar comes from Warren Buffett's own painful experience with the company that gave his legendary holding company its name, Berkshire Hathaway. When Buffett first took control of Berkshire Hathaway in the mid-1960s, it was a struggling textile manufacturer in New England. The textile business was, to put it mildly, terrible. It was capital-intensive, faced relentless foreign competition, and generated abysmal returns on investment. For years, Buffett, a young man who had built his early fortune buying wonderful businesses at fair prices, found himself trapped. He was running a terrible business. He tried to make it work. He poured millions of dollars of the company's meager profits back into the textile operations, buying new machinery and trying to eke out a small competitive advantage. He was, in his own words, pouring good money after bad. He was operating outside of what would become his circle of competence, identifying and owning businesses with durable competitive advantages. The textile mill was a black hole for capital. Every dollar he reinvested generated a pitiful return. It was a constant, grinding struggle that taught him an invaluable lesson. As he later wrote in his shareholder letters, "It is better to have a partial interest in the Hope Diamond than to own all of the rhinestone." The textile business was a rhinestone, and no amount of managerial skill or fresh capital could transform it into a diamond. The turning point came when he started using the small profits from the textile business not to reinvest in more looms, but to acquire other, better businesses. He bought insurance companies like National Indemnity and later Geico. He bought See's Candies. These were businesses he understood. businesses that operated within his burgeoning circle of competence. They required little capital, generated mountains of cash, and possessed strong, defensible brands. Finally, in 1985, after 2 decades of struggle, Buffett made the painful but rational decision to shut down the textile operations completely. It was an admission of defeat, but it was also an act of supreme capital allocation genius. He stopped throwing good money after bad and liberated that capital for deployment in his high-return insurance and investment operations. The story of the Berkshire textile mills is not a story of failure. It is the story of Buffett discovering the paramount importance of the circle of competence. He learned firsthand that even the greatest manager in the world cannot save a fundamentally flawed business. And more importantly, he learned that the most intelligent use of a CEO's time and a company's capital is to focus exclusively on areas where the company has a distinct and sustainable advantage. His mistake with the textile business, and his eventual correction of it, provided the intellectual foundation for turning Berkshire Hathaway into the powerhouse it is today, a collection of wonderful businesses, each operating squarely within a well-understood circle of competence. This brings us to the underlying psychological principle at play, the Dunning-Kruger effect, and its close cousin, the overconfidence bias. The Dunning-Kruger effect is a cognitive bias in which people with low ability at a task overestimate their ability. In the corporate world, this often manifests in CEOs who, having achieved great success in one industry, mistakenly believe they possess a golden touch that can be applied to any industry. A brilliant software executive decides he can revolutionize the media business. A masterful retailer decides they can conquer the world of financial services. This is overconfidence in action. The skills that lead to success in one domain do not necessarily translate to another. An encyclopedic knowledge of semiconductor manufacturing is of little use when trying to assess the box office potential of a Hollywood film. Yet, the ego that often accompanies success makes it difficult for many leaders to admit the boundaries of their own expertise. They start to believe their own press clippings. This psychological trap is the gateway to diversification. The CEO mistakes their success in a specific field for a general, all-purpose genius, leading them to make acquisitions in areas they don't remotely understand, often paying a premium for their own ignorance. This is a critical failure in executive decision-making that proper management analysis must uncover. To guard against this, we can develop an applied mental model for our own use, which we'll call the due diligence litmus test. This is a checklist you, as an investor, can use whenever a company you own or are researching announces an acquisition, especially one outside its core industry. It's a tool for spotting the red flags of value-destroying diversification, a cornerstone of financial education for any serious retail investor. First, the industry track record test. Does the target company operate in an industry where the acquiring company's management has a deep and proven track record? Be specific. If a software company buys another software company, that's a good sign. If a software company buys a chain of restaurants, your alarm bells should be ringing. You must ask, what specific expertise does this CEO bring to this new industry? If the answer isn't immediately obvious and compelling, it's a major red flag. Second, the rationale clarity test. Is the official reason for the acquisition based on clear, understandable, and quantifiable synergies, or is it based on vague, grandiloquent corporate jargon? This acquisition will allow us to leverage our core competencies to create a paradigm-shifting, value-added consumer experience. Is meaningless noise. This acquisition allows us to take their existing product and push it through our 10,000-store distribution network, which we estimate will increase sales by 40% within 2 years, is a clear, testable hypothesis. Insist on clarity. Vague language is often used to mask a lack of clear thinking. Third, the humility test. How does the CEO talk about the acquisition? Read the press release, listen to the conference call. Do they speak with humility, acknowledging the challenges and the risks of entering a new field? Do they lay out a detailed, logical plan for integration? Or do they make bombastic, arrogant pronouncements about how they are going to disrupt and revolutionize an industry they just entered yesterday? Arrogance is the enemy of good capital allocation. Look for leaders who display a healthy respect for the complexity of the business they are buying. This is a subtle but powerful indicator of a rational mindset. Fourth, the post-mortem test. Analyze the company's past acquisitions. This is crucial. Go back 5 or 10 years. Look at the deals they've made. What price did they pay? Often measured by the enterprise value to EBITDA multiple. How has that acquired division performed since? Does the company provide clear financial reporting on the performance of its acquired units, or are the results conveniently buried within a larger divisional reporting structure? A track record of successful, well-integrated acquisitions is a powerful positive signal. A history of overpaying for assets that subsequently underperform or are written down is the reddest flag of all. Now for the antithesis. The path of the 99% is littered with the wreckage of companies that failed this test. While many examples exist, the story of General Electric under Jeff Immelt, Jack Welch's successor, serves as a powerful cautionary tale of diversification. For decades, GE was the quintessential American industrial conglomerate. Under Welch, it expanded aggressively, but often into adjacent or related fields. However, in the 2000s, under Immelt, the company strayed further and further from its industrial roots. The most significant and ultimately disastrous foray was the dramatic expansion of GE Capital, its financial services arm. At its peak, GE Capital was essentially one of the largest banks in the United States, involved in everything from commercial real estate lending to consumer credit cards. The problem was that GE's core competence was in building and selling jet engines, power turbines, and medical equipment. Its management team were industrial engineers and operators, not sophisticated risk managers in the world of high finance. They were operating far outside their circle of competence. For a time, during the credit boom of the mid-2000s, this didn't seem to matter. GE Capital was generating enormous paper profits, and Wall Street applauded. But when the financial crisis hit in 2008, the house of cards collapsed. GE's exposure to risky mortgages and complex financial instruments brought the entire company to its knees. The industrial titan that had survived world wars and depressions suddenly required a government bailout to stay afloat. The diversification into finance had almost destroyed the entire company. In the years that followed, GE was forced to dismantle its own empire, selling off vast chunks of GE Capital at fire sale prices and divesting other non-core assets like its NBC Universal Media division. The stock, once a blue-chip stalwart, languished for over a decade, destroying immense shareholder value. This was a direct result of management straying from what they knew best, seduced by the illusory profits of a business they did not truly understand. The direct financial connection of this principle is stark and measurable. It manifests primarily in the metric of return on invested capital, or ROIC. A company that stays within its circle of competence tends to have a high and stable ROIC. When it reinvests capital, it does so in projects and businesses it understands, and is therefore able to generate strong returns. Think of a company like See's Candies. It has a simple, understandable business with a powerful brand. When Berkshire invests capital to open a new See's store, they have a very high degree of confidence in the return that capital will generate. The balance sheet of such a focused business is clean and easy to understand. Now consider the diversified conglomerate. When it acquires a business in an unrelated field, it often buys a company with lower returns than its core operations. This immediately dilutes the company's overall ROIC. The balance sheet becomes a bloated, complex mess of disparate businesses, making it almost impossible for an investor to analyze. The company becomes a collection of mediocre assets, none of them managed with world-class expertise. This inevitably leads to a lower valuation multiple from the market. The sum of the parts becomes worth less than the individual pieces would be on their own. A conglomerate discount. By sticking to their circle of competence, a CEO protects the company's profitability, preserves its focus, and maximizes long-term portfolio growth for shareholders. Venturing outside of it, for reasons of ego or a misguided pursuit of growth, is a reliable path to mediocrity and a clear signal for any practitioner of value investing to stay away. The third pillar, and perhaps the one that requires the most discipline from a CEO, is an obsessive focus on the price paid for any asset. It's a simple, almost brutally obvious concept that is shockingly rare in practice. A wonderful business can be a terrible investment if you overpay for it. The best capital allocators are not just brilliant strategists, they are disciplined, almost fanatical, bargain hunters. They understand that buying the right asset is only half the equation. Buying it at the right price is the other, equally important half. They are willing to walk away from any deal, no matter how strategically attractive, if the price is not right. This discipline, this refusal to get caught up in the emotion and ego of a bidding war, is a core trait that separates wealth-creating CEOs from their value-destroying peers. This skill is at the heart of corporate finance and is a non-negotiable for achieving financial freedom through investing. The foundational anecdote that perfectly encapsulates this principle is the story of how Warren Buffett bought the Nebraska Furniture Mart from its legendary founder, Rose Blumkin, affectionately known as Mrs. B. This story is a masterclass in focusing on business value and ignoring the typical Wall Street circus of mergers and acquisitions. In 1983, Mrs. B, then nearly 90 years old, had built the Nebraska Furniture Mart from a tiny operation in a basement into the single largest home furnishing store in the United States, doing over $100 million in annual sales from a single location in Omaha. Her business philosophy was simple: sell cheap and tell the truth. She ran her business with incredible efficiency and a fanatical devotion to her customers, and as a result, she dominated her market. Buffett had been a customer for years and admired her business acumen from afar. One day, he decided he wanted to buy the company. What followed was not a typical acquisition. There were no investment bankers, there were no teams of lawyers or accountants conducting months of due diligence. There was no auction or bidding process. Buffett simply went to see Mrs. B. He asked her what the business earned and what its assets and liabilities were. She told him. He asked her what price she wanted. She gave him a number. Buffett thought for a moment and realized the price was exceptionally reasonable for a business of that quality. He wrote out a one-page contract, they both signed it, and he gave her a check for nearly $60 million. The deal was done. Later, Buffett would recount the story, emphasizing a key point. He didn't ask for an audit. He didn't try to haggle over the price. Why? Because he knew two things with absolute certainty. First, Mrs. B was an honest operator. Her character was impeccable. He trusted her numbers. Second, and most importantly, the price she offered him provided a massive margin of safety. He knew he was buying a phenomenal business at a very fair price. Even if her numbers were off by 10 or 20%, he was still getting a bargain. He was buying the business, not a meticulously audited financial statement. His focus was on the intrinsic value and the price he was paying relative to that value. This simple, trust-based transaction, devoid of all the usual M&A friction, stands in stark contrast to the way most corporate acquisitions are done. It is a testament to the power of focusing on what truly matters, the quality of the business and the price you pay for it. The psychological principle that drives most CEOs to violate this rule is a powerful cognitive bias known as the winner's curse. This phenomenon, first identified in studies of auctions, describes the tendency for the winning bid in an auction to exceed the intrinsic value of the item being sold. In other words, the winner is often the biggest loser because they are the one who most overvalued the asset. This bias is rampant in corporate M&A. When a company is put up for sale, it often attracts multiple bidders. An auction-like atmosphere develops. The CEOs of the bidding companies, driven by ego, competitive fire, and the advice of investment bankers who get paid huge fees only if a deal closes, get caught up in the thrill of the chase. The desire to win the deal begins to overshadow the rational analysis of whether the deal makes financial sense. They inch their bids higher and higher, determined not to be outdone by a rival. When the dust settles, one company emerges victorious, having won the asset. but they have often paid a price so high that it becomes mathematically impossible for the acquisition to ever generate a reasonable return on investment. They have fallen victim to the winner's curse. The disciplined CEO, the one acting as a true steward of shareholder capital, must have the emotional fortitude to recognize when a bidding war has broken out and simply walk away. This is a crucial element of management analysis that separates the pros from the amateurs. To put this into practice, we can create a mental model called the margin of safety mandate for CEOs. This is how you, as an investor, can critically assess whether a management team is applying the necessary price discipline to its acquisitions, a key skill for advanced stock picking. First, analyze the valuation multiple. When a deal is announced, the first thing you must do is calculate the price being paid in terms of a standard valuation multiple. This could be the price-to-earnings PE ratio, the enterprise value to EBITDA, EV/EBITDA ratio, or the price-to-sales ratio. Look at the numbers. Is the acquiring company paying 10 times earnings or 50 times earnings? Is the EV/EBITDA multiple 8x or 18x? Second, compare the multiple to historical and industry averages. A multiple in isolation is meaningless. It needs context. Compare the price being paid to the historical valuation range of the target company. Are they buying it at a multi-year high? Compare it to the average valuation multiples for other companies in the same industry. Are they paying a significant premium to the peer group? If so, there must be an extraordinarily compelling reason to justify it. Often there isn't. Third, compare it to the acquirer's own multiple. This is a subtle but critical point. Is the acquiring company using its own highly valued stock, say trading at 25 times earnings, to buy a company that is less highly valued, trading at 15 times earnings? This can be an accretive use of an expensive currency. The danger is the reverse. A company with a reasonably valued stock using that stock, or worse, cash and debt, to acquire a business trading at a nosebleed valuation. This is a recipe for value destruction. Fourth, scrutinize the goodwill. After an acquisition closes, go to the acquirer's next quarterly balance sheet and look for a line item called goodwill. Goodwill is the accounting plug that represents the premium paid for a business over the fair market value of its identifiable assets. A small amount of goodwill is normal. A massive goodwill figure, especially one that represents a large percentage of the total deal value, is a giant, screaming red flag. It is the company's own accountants admitting, in their own language, that the CEO paid a huge premium for the asset. This goodwill sits on the balance sheet like a ticking time bomb, waiting to be written down if the acquisition fails to perform as expected. Now let us examine the antithesis, the path of the 99%, the deal junkie CEO. This is the executive who feels an irresistible compulsion to do deals, to be constantly acquiring, to make headlines. Their identity is tied up in being a consolidator. Their focus shifts from creating value to simply creating activity. A classic and painful example of this is Yahoo's acquisition of Tumblr in 2013. At the time, Yahoo, under CEO Marissa Mayer, was a struggling internet giant desperate to become relevant again, especially with a younger audience. Tumblr was a hot, fast-growing social media and blogging platform, immensely popular but generating almost no revenue. Mayer, driven by the need to make a bold move, acquired Tumblr for $1.1 billion in cash. The strategic rationale was flimsy, based on the hope that Yahoo could somehow monetize Tumblr's user base without alienating it. The price, however, was demonstrably insane. Paying over $1 billion for a company with negligible revenue was a massive gamble. The investment community was skeptical, but Mayer was celebrated in some circles for her bold vision. The deal was a catastrophic failure. Yahoo's corporate culture clashed with Tumblr's freewheeling, creative environment. The monetization efforts sputtered. The user base stagnated. Just a few years later, after Yahoo itself was acquired by Verizon, the value of Tumblr was written down to virtually zero. The entire $1.1 billion of shareholder cash had been incinerated in a single, ill-conceived capital allocation decision. Marissa Mayer had fallen victim to the need to do something and had massively overpaid for a story stock, ignoring the fundamental business reality. This is the behavior of the deal junkie, and it is toxic to shareholder value and portfolio growth. The direct financial connection here is one of the most brutal in all of finance. When a company overpays for an acquisition, the financial damage is twofold. First, there is the opportunity cost. The billions of dollars spent on the overpriced asset could have been used for other, more productive purposes, reinvesting in the core business, paying down debt, or buying back its own stock at a reasonable price. That potential for value creation is lost forever. Second, and more visibly, is the impact of the inevitable goodwill write-down. As we discussed, the massive goodwill created by overpayment sits on the balance sheet. When it becomes clear that the acquired asset will never generate the profits needed to justify the purchase price, accounting rules force the company to take a, quote, goodwill impairment charge. This is not some abstract accounting entry. An impairment charge is a non-cash expense that flows directly through the income statement, often resulting in a massive reported loss for the quarter. It is the company's formal admission to the world that management made a terrible mistake and destroyed shareholder capital. It craters reported earnings, reduces shareholder equity on the balance sheet, and almost always leads to a sharp decline in the stock price. The CEO who avoids the winner's curse and insists on a margin of safety in every transaction protects you from this financial carnage. The CEO who is a deal junkie virtually guarantees that you will eventually suffer it. For any practitioner of value investing, learning to spot this difference is a requirement for survival and success. Our fourth pillar delves into what is arguably the ultimate test of a CEO's rationality and their commitment to per-share value: the strategic use of share buybacks. A company's share repurchase program is not merely a financial maneuver. It is a declaration of the CEO's belief about the value of their own company. Executed with intelligence and price discipline, buybacks can be a powerful engine of wealth creation for shareholders. Executed foolishly, pro-cyclically, and at inflated prices, they become one of the most efficient ways for a management team to vaporize shareholder capital. A CEO's buyback record, therefore, serves as an unvarnished, quantifiable report card on their ability to think like a true business owner. It reveals whether they are genuinely focused on increasing your ownership stake in the business at attractive prices, or if they are simply manipulating earnings per share and propping up the stock price for their own benefit. The foundational anecdote for this pillar is the story of a man who is a legend among serious students of capital allocation, though he is less known to the general public than Buffett. His name was Dr. Henry Singleton, the founder and CEO of a conglomerate called Teledyne. Singleton was an absolute master of capital allocation, and his primary tool was the strategic, opportunistic share buyback. His story is the gold standard by which all other repurchase programs should be judged. Singleton built Teledyne through a flurry of acquisitions in the 1960s, using his company's highly valued stock as currency to buy solid, cash-generating industrial businesses. But by the early 1970s, the market had turned. The conglomerate boom was over, and Teledyne's stock, along with those of its peers, was crushed, falling to a valuation that Singleton knew was absurdly cheap. At this point, a typical CEO would have panicked, or perhaps continued to pursue growth through acquisitions. Singleton did something radical. He completely stopped making acquisitions. He looked at the universe of investment opportunities and concluded that the single most attractive, most undervalued asset he could possibly buy was his own company's stock. So, from 1972 to 1984, Henry Singleton and Teledyne embarked on one of the most aggressive and intelligent share repurchase campaigns in corporate history. He used every dollar of the company's prodigious free cash flow to buy back its own shares on the open market. He didn't do it to signal confidence or to return cash to shareholders in the generic sense. He did it for one simple reason. He was getting a dollar's worth of business assets for 50 cents or 30 cents, or sometimes even less. It was the best investment available to him. The result was astonishing. Over that 12-year period, Teledyne repurchased over 90% of its outstanding shares. 90%. For the shareholders who held on, the effect was magical. Their ownership stake in the underlying businesses grew tenfold without them having to invest another dime. Even if the total earnings of Teledyne's businesses stayed flat, the earnings per share grew at a phenomenal rate simply because the share count was constantly shrinking. This aggressive, value-based buyback program was the primary driver behind Teledyne's stock, delivering a compound annual return that dwarfed the S&P 500 for over 2 decades. What makes Singleton's story so instructive is what he did next. In the mid-1980s, the market began to recognize the value he had created, and Teledyne's stock price soared. It was no longer cheap. And so, just as suddenly as he had started, Henry Singleton stopped buying back stock. The bargain was gone. He was not a mindless repurchaser. He was a value-based allocator. His actions provide the ultimate lesson. Buy back shares aggressively when they are trading at a significant discount to intrinsic value, and stop when they are not. It is the purest form of rational, shareholder-oriented behavior. The underlying psychological principles that lead most CEOs to get this so wrong are the agency problem and simple herd behavior. The agency problem describes the inherent conflict of interest between a company's management, the agents, and its stockholders, the principals. While the stockholders' goal is the long-term maximization of per-share value, management's goals can be quite different. A CEO's bonus is often tied to metrics like growth in earnings per share, EPS. A share buyback, even one done at a terrible price, mechanically reduces the number of shares, which can artificially boost EPS and trigger a huge bonus for the executive. They are essentially using the company's money to pay themselves, at the expense of long-term value. This is compounded by herd behavior. When a company is flush with cash and its stock price is hitting new highs, there is immense pressure to do something with that cash. Everyone else is buying back stock, so we should too. This leads to the perverse and incredibly common spectacle of companies buying back the most shares when their stock price is at its peak, and then stopping the buyback program or even issuing new shares when the price has crashed. They are systemically buying high and selling low with shareholder money, the exact opposite of what any rational investor would do. To combat this and identify the truly rational allocators, we can use an applied mental model called the buyback scorecard. This is a practical tool for any retail investor to grade a company's share repurchase program and, by extension, the quality of its management. First, price discipline. This is the most important factor. Create a simple chart. On one axis, plot the company's stock price over the last 5 to 10 years. On the other axis, plot the number of shares they repurchased each quarter. What you are looking for is an inverse correlation. A rational, Singleton-like CEO will have spikes in buyback activity during periods when the stock price is low and depressed. An irrational CEO will have the biggest spikes in buyback activity when the stock price is at or near its all-time highs. This single chart can tell you almost everything you need to know about the CEO's mindset. Second, motive and communication. Read the annual reports and the shareholder letters. How does the CEO talk about the buyback program? Is it just a generic, open-ended authorization announced in a press release with no context? Or does the CEO clearly articulate in the letter real and tells why they believe the company's stock is undervalued at current prices? A great allocator will explain their thinking. They will treat you like a partner and lay out the logic behind their decision, often stating that they believe the stock is the most attractive investment the company can make at that price. A lazy or conflicted allocator will just go through the motions. Third, alternative uses and funding. Consider the context of the buybacks. Was the company buying back its stock while simultaneously underinvesting in its core business? Did they forego a high-return internal project in order to buy back overvalued shares? This is a sign of poor priorities. Also, how was the buyback funded? Was it paid for with internally generated free cash flow? That's ideal. Or did the company take on a huge amount of debt to fund the buyback? This is extremely risky. It leverages up the balance sheet, adding financial risk to the remaining shareholders, all to repurchase shares at what might be an unattractive price. This is a common tactic of private equity, but can be dangerous for a publicly traded company. Now for the antithesis, the path of the 99%, the pro-cyclical buyer. This is the company that perfectly mirrors the irrationality of the crowd. They feel richest when their stock price is high and cash is pouring in, and that's precisely when they buy back the most stock. When a recession hits and their stock price plummets, they get scared, slash the buyback program to conserve cash, and wait for the good times to return. They are hardwired to buy high. Many large established companies have been guilty of this over the years. Take a company like IBM during certain periods in the 2010s. For years, the company spent tens of billions of dollars on share repurchases, often at historically high valuations. This was done in large part to help the company hit its ambitious roadmap EPS targets. The buybacks helped mask the fact that the company's actual revenue and net income were stagnating or declining. Management was engineering EPS growth by shrinking the share count, not by growing the underlying business. When the market finally recognized the operational weakness, the stock entered a long period of decline, meaning all those billions were spent buying back shares at prices far higher than where they would trade for years to come. It was a massive destruction of shareholder value, papered over by financial engineering. This is the opposite of Henry Singleton's approach. It is using buybacks as a tool of obfuscation, not a tool of value creation. The direct financial connection of share buybacks is pure, simple mathematics. It's one of the clearest ways to see how a CEO's decision directly impacts your personal wealth. Let's take a simple company that earns $1 million per year and has 1 million shares outstanding. Its earnings per share, EPS, is $1. Let's assume the company's stock trades for $10 per share, giving it a market capitalization of $10 million. Scenario A, the rational allocator. The CEO believes the company's intrinsic value is actually $15 per share. Seeing the stock at $10, he recognizes a bargain. He uses $1 million of the company's cash to buy back 100,000 shares at $10 each. The company now has only 900,000 shares outstanding. The next year, the company earns the same $1 million in profit. But now, that $1 million is divided by only 900,000 shares. The new EPS is $1.11. The CEO has increased your claim on the company's earnings by 11% without the underlying business having to grow at all. This is a powerfully accretive act. Scenario B, the pro-cyclical buyer. The CEO waits until the stock market is roaring, and the company's stock has run up to $20 per share, a price he knows is above its intrinsic value. But he's flush with cash and feeling pressure to act. He uses the same $1 million to buy back shares. At $20 per share, he can only retire 50,000 shares. The company now has 950,000 shares outstanding. The next year, the company earns $1 million. The new EPS is now $1.05. The benefit to the remaining shareholders is less than half of what it was in Scenario A. He has spent the same amount of money for a much worse result. Even worse, if the stock price later falls back to its intrinsic value of $15, the company will have a realized loss of $5 on every single share it repurchased. This is how billions of dollars of shareholder wealth are squandered every year. A CEO's buyback record is not a footnote. It is a clear, quantifiable measure of their financial acumen and their allegiance to shareholder value. It is a critical piece of evidence in any serious management analysis. The fifth and final pillar of our framework is perhaps the most qualitative, yet it is also one of the most revealing. It is the analysis of the CEO's annual letter to shareholders as a direct window into their mind. The shareholder letter is not, as many assume, a simple marketing document or a boring legal disclosure. For a great CEO, it is the single most important piece of communication they produce all year. It is a confession, a progress report, and a philosophical treatise all rolled into one. It is where they have the opportunity to speak directly to you, their business partners, without the filter of the media or Wall Street analysts. The clarity of their writing, their candor about mistakes, and the metrics they choose to focus on reveal everything about their thought process, their character, and their fundamental approach to capital allocation. Learning to read a shareholder letter like a forensic accountant is the ultimate skill in separating the truly great leaders from the jargon-spouting obfuscators. The foundational anecdote for this pillar is, without question, the entire collection of Warren Buffett's annual letters for Berkshire Hathaway. These letters are the undisputed gold standard of corporate communication and serve as the benchmark against which all others must be measured. For over 50 years, Buffett has used his letters to educate, inform, and entertain his shareholders. Reading a Buffett letter is like taking a masterclass in business and investing. He explains complex financial concepts like float, goodwill, and intrinsic value in simple, plain English, using analogies and homespun wisdom. He is relentlessly candid about his mistakes. In his 1993 letter, he famously wrote about his acquisition of Dexter Shoe Company, which he bought using Berkshire stock. The shoe business subsequently went to zero, a complete failure. Buffett wrote, "To date, Dexter is the worst deal that I've made, but I'll make more." He then went on to calculate the exact cost of his mistake to Berkshire shareholders in terms of the value of the Berkshire stock he gave away, a number that ran into the billions. This level of honesty is unheard of in corporate America. Most CEOs bury their mistakes or try to spin them as learning experiences. Buffett puts them front and center and quantifies the damage. Furthermore, Buffett's letters clearly lay out his and Charlie Munger's criteria for acquisitions and their philosophy on capital allocation. He tells shareholders exactly what they are looking for in a business and what kind of behavior they can expect from management. He treats his shareholders not as a faceless mob, but as intelligent partners who have entrusted him with their capital for the long term. Contrast this with a typical shareholder letter from a Fortune 500 company. It is almost always a sterile, jargon-filled document, likely written by a committee of lawyers and public relations staff. It is filled with meaningless phrases like leveraging synergies, driving stakeholder engagement, and executing on our strategic imperatives. Mistakes are never mentioned. Every division, no matter how poorly it is performing, is described as being, quote, well-positioned for future growth. The metrics they celebrate are often non-standard, adjusted figures that paint a far rosier picture than reality. This document is not designed to inform. It is designed to manage perceptions. The difference between a Buffett letter and a typical corporate letter is the difference between a candid conversation with a trusted partner and a slick sales pitch from a stranger. The underlying psychological principles at play here are the power of transparency and the principle of reciprocity. When a CEO is transparent, when they are candid about their failures, clear in their explanations, and honest in their assessments, they build an immense reservoir of trust with their shareholders. This trust is an invaluable asset. It allows the CEO to make long-term decisions without having to worry about short-term market reactions. Shareholders who trust their CEO are less likely to panic and sell during a downturn because they understand the long-term strategy. This is reciprocity in action. The CEO gives the shareholders honesty and clarity, and in return, the shareholders give the CEO their patience and their long-term capital. Conversely, a CEO who uses obfuscating language, who never admits a mistake, and who celebrates vanity metrics is signaling a fundamental disrespect for their shareholders. They are treating their investors as dumb money, an outside constituency to be managed and manipulated. This behavior destroys trust and signals that the CEO's interests are likely not aligned with those of the owners of the business. This leads us to our final applied mental model, the annual letter deconstruction kit. This is a checklist of questions to ask yourself as you read any company's annual shareholder letter. It will help you cut through the noise and assess the quality of the mind running the business, a crucial skill for any investor focused on beating the market. First, the candor test. Does the CEO openly and honestly discuss the company's failures and setbacks from the past year? Do they take personal responsibility for mistakes, or do they blame external factors like the economy or competition? Look for the CEO who says, "I made a mistake," not the one who says, "We faced headwinds." The former is a leader, the latter is a PR manager. Second, the clarity test. Is the letter written in simple, clear, plain English that any intelligent person can understand? Or is it littered with corporate buzzwords, acronyms, and impenetrable jargon? Great leaders are great communicators. They can explain complex ideas simply. An over-reliance on jargon is often a sign of muddled thinking, or, worse, a deliberate attempt to hide something. If you can't understand what the CEO is saying, that's usually their fault, not yours. Third, the metrics test. What financial metrics does the CEO focus on? Are they celebrating meaningless, manipulated metrics like adjusted EBITDA or non-GAAP earnings? These are often figures that exclude real costs like stock-based compensation or restructuring charges. Or does the CEO focus on honest, owner-oriented metrics like return on equity, ROE, return on invested capital, ROIC, and, most importantly, the long-term growth and per-share intrinsic business value? The metrics a CEO chooses to highlight reveal their true priorities. Fourth, the capital allocation section test. Is there a dedicated section of the letter where the CEO thoughtfully explains the major capital allocation decisions of the year? Do they explain why they chose to make that big acquisition, why they bought back stock at a certain price, or why they chose to increase the dividend? A great letter will walk you through the logic. A poor letter will simply list the decisions without providing any context or rationale, as if they were just items on a shopping list. Now for the antithesis, the jargon-spewing obfuscator. This is the CEO whose letters are masterpieces of corporate nonsense. Let's imagine a paragraph from such a letter. In fiscal 2023, we continued to execute against our strategic pillars, leveraging our best-in-class platforms to drive synergistic growth and optimize our global footprint. Our proactive initiatives in stakeholder value creation have positioned us to capitalize on emerging paradigm shifts and unlock significant upside potential moving forward. This paragraph contains absolutely zero information. It is a collection of empty buzzwords strung together to sound impressive while saying nothing. It is a smokescreen. When you read language like this, your guard should go up immediately. This is the language of a CEO who is not a partner but a politician. They are not trying to inform you, they are trying to manage your perception of their performance. This style of communication is a massive red flag that often correlates with poor capital allocation decisions and a culture that prioritizes appearances over substance. The direct financial connection of this final pillar is the ultimate correlation in the world of investing. The CEOs who write the clearest, most rational, most candid shareholder letters are almost invariably the same CEOs who have delivered the best long-term financial results and shareholder value. Think of Warren Buffett at Berkshire Hathaway, Jeff Bezos in his early Amazon letters, or Mark Leonard of Constellation Software. Their clear, logical, owner-oriented writing was not a coincidence or a stylistic quirk. It was a direct reflection of their clear, logical, owner-oriented thinking. And that thinking is what drove the brilliant capital allocation decisions that led to staggering portfolio growth. Clear writing is a proxy for clear thinking. A CEO who can articulate their strategy with logic and candor is far more likely to execute that strategy with discipline and rationality. By making the shareholder letter a key part of your management analysis, you gain an incredibly powerful, forward-looking indicator of future performance. You learn to invest not just in a company's assets, but in the quality of the mind that is allocating capital on your behalf. This is the final and perhaps most profound piece of the puzzle. In learning how to spot the CEOs who will make you rich, you have just invested a significant amount of your most valuable asset, your time, to rewire the very way you analyze a business. You should feel a profound sense of accomplishment. You have moved beyond the superficial narratives of sales growth and media headlines that trap the average investor. You have acquired a powerful, 5-part mental toolkit for judging a CEO not on their charisma or their operational prowess, but on the single most important driver of long-term wealth, their skill as a capital allocator. You now possess the framework to distinguish the disciplined stewards of your capital from the ego-driven empire builders. This is not just another piece of financial trivia. It is a fundamental upgrade to your investment operating system, a durable advantage that will serve you for the rest of your investing life. But here is the crucial insight. A powerful tool is only as effective as the system in which it operates. What you have just mastered, the art of analyzing a CEO's capital allocation decisions, is one of the most critical components in the entire value investing philosophy, pioneered by Benjamin Graham and perfected by Warren Buffett. However, it is still just one component. Buffett's system is not a collection of isolated tricks. It is a latticework of interconnected mental models. Understanding management is critical, but it must be combined with the ability to analyze a company's competitive advantages, to calculate its intrinsic value, and to apply a margin of safety. Each concept reinforces and gives context to the others. You have just forged a crucial piece of the map, but the map itself is far larger and more intricate. The video that is now appearing on your screen is not a random suggestion. It is the next logical step in this journey. It is the missing link, the piece that connects the who of management analysis to the what of business analysis, or the how much of valuation. It represents the next node in the network of knowledge you are building. It is the bridge from understanding the pilot to understanding the aircraft itself. To click away now would be like learning how to perfectly sharpen a chisel but never learning how to build the cabinet. The tool is useless without the rest of the plan. This is the moment of decision. The person who was merely curious, who was looking for a single hot tip, will likely click away. But the person who is serious about achieving financial freedom, the individual who understands that success comes from building a complete mental arsenal, not from collecting disconnected facts, will recognize this opportunity. This next click is not about watching another video. It is a conscious choice to continue your ascent. It is a declaration that you are not a dabbler, but a builder. Complete your arsenal, master the entire framework. The next piece of the map is waiting for you. Click and continue the journey.